Charles, maybe share some of the indicators that you use to kind of give you that sense of how bad it's gotten on the sentiment side, those oversold indicators. So, what are some of your favorites?
So some of my favorite indicators on the contra indicators or psych indicators are the Investors Intelligence Bull Bear Survey,
Hmm.
and then the AAII Investor Sentiment Survey. So the first one is a survey of investment advisors, kind of professionals,
Hmm.
and the AAII is a survey of individuals, kind of the broader public. I take a look at the VIX, volatility index. I take a look at the put to call ratio. I pay a lot of attention to the short-term overbought oversold oscillator, which has a decent record of marking lows in the market, but this year has been an exception. I look at the new highs and new lows, and I pay attention to the stochastics, among others. So those are the main ones I look at. And what I'd say this year is that I have over relied on these secondary indicators to my detriment because I've been trying to be a little bit anticipatory, um, you know, taking stabs at the market here and there in the anticipation of a bottom, as opposed to just waiting for the follow through day, which is kind of tried and true at least.
Hmm.
And it's this year has been tough for me because it's these secondary indicators have not really worked. The market hit new lows just yesterday. But if you look at many of these measures this year, they have the market has been very oversold by many measures the entire year. I mean, I was saying back in January, February, like, oh my God, we're way oversold.
Right.
Yeah.
And yet, we've been going down for another, 9 months, right?
Hmm.
From we're 10 months. So it's been, I think the message or the lesson is they're called secondary indicators for a reason. You don't
Hmm.
want to put, use them, but use them in conjunction with the follow through day, or at least use them with the knowledge that they aren't always going to be accurate. And you can be, you can be right within a week, but in that 1 week, you can lose 20%, right? So, it's hard to time, but maybe we can go through a few examples and I can show you how usually they do a pretty good job. And
Yeah.
so, again, we spoke about in the first segment that we're in a bear market that is, we haven't experienced this kind of bear market in a long time.
Hmm.
It's been since 2008, 2009. So it's been, what, 12 years since we've been in this serious a bear market, whereas all the other corrections we've had since then have been either much faster to resolve
Hmm.
or not as severe on the downside, but a little more extended to play out, like 2015, 16 kind of time frame, where it was just kind of, you wear them out instead of scare them out.
Hmm.
This, I think, has been a combination of both. I mean,
Right.
it's wearing us out and it's scaring us out. Um,
So
so
Charles, maybe like we have the screen of the NASDQ up here, an image from Wanda up here. Maybe walk us through a couple of the ones that probably your top two that you look at here, just to get like the indications on the secondary indicators.
okay, well, so on this image, the top panel is the put to call ratio.
Hmm.
And we see a spike back in it looks like the June time period. So that first kind of low where that started that tradable rally.
Yeah.
We see a spike up to about 1.25 or so,
Right. Right.
1.25.
Hmm.
Yep.
And then just a week or two ago, we hit another spike at that level.
Yeah.
So, of course, you can see that it did not mark the low because we went lower. So normally you get spikes where where there are, more puts to calls. It means people are getting very defensive and nervous, and oftentimes they coincide with market lows. This year hasn't quite again matched up. The panel below that is the bull bear survey results. And you can see that for a large part of this year, there has been more bears than bulls.
Mhm.
And that's pretty rare. You don't go through long periods of time where that occurs, unless you're in a severe bear market, and which is what we're in. It's in most of the bear markets or the corrections we've had over the past 10 or 12 years, where the market was down, more like in the 20-25% range,
Yeah.
or high teens. You never saw the bears exceed the bulls, or if they
Yeah, I
did, it
mean,
was
those
maybe for a day.
crossovers are so rare. I
They're
would remember
very
that.
rare.
Once every few years, it would cross over
Yes.
maybe once, right?
And yet this year we've had week after week after week where bears have exceeded bulls. So, that's really just informing us that we've been in something really different.
Mhm.
Now, the panel below that is the short-term overbought, oversold oscillator. Now, I thought this was really interesting. Back in January 27th, so that was that low that you're pointing to right now.
Yeah.
The NASDAQ hit a low of 1897, minus 1897. That is the lowest it had ever been in the history of the NASDAQ.
Wow.
So
It's ridiculous.
and yet that was in January.
Yeah.
And and that did mark a kind of, I think, a short-term bounce, but it wasn't really tradable. Interestingly, the second worst reading was October 28th of 87, where it was a minus 1714.
Wow.
That was the low of the market in the 87 crash. So that was the low point. So in 87, that spike down actually did mark the low.
Yeah.
So I was kind of optimistic that, oh, look, we have another, historical spike down. Never happened before.
Yep.
The market's going to recover, and yet this time around it didn't. And keep in mind that the 87 crash was a very short bear market. I mean, it was a crash.
Yep.
And then it took a number of years to kind of come back, but it hit a low and then it worked its way back up. Before the 87, the next lowest one was September 1st of 98, which is the oscillator hit a minus 1500. And that was the bottom of the first leg down of that 98 market. If you recall, we had a severe bottom, and then we had a tradable rally up to the 200-day, and then a shakeout undercut. And then that began the great last leg of the bull market.
Yeah.
That took us all the way up to March of 2000. So we're really in kind of unprecedented territory. And you can see that just a few weeks ago, the market hit another low of 16, it looks like around 1650 or so, which is the third or worst rating in history. And so, by these measures, you would expect us to be somewhere near a low.
Yeah.
But
now
again,
the only thing though, so those other two examples, 87 and 98, you had kind of that big kind of washout, right? A huge kind of sell off.
It's very quick and severe.
Yeah, here we haven't had that yet.
Well, but we did in January. It was pretty quick and severe in January. It's just that it's been so persistent.
True,
right?
True. Yeah. So in the January we definitely had it, but for this last time, a few weeks ago, we haven't necessarily had it, right?
Yeah.
Well, it definitely. Again, we're in a different kind of bear market because, again, this is an extended bear market, whereas 98 was a 3 months down, NASDAQ correcting about 32 or so percent. We're down 36% at our lows over almost 11 months. So it is a different play. But I will say that, I don't know about you, I'm feeling a little panicky. I mean, it's been pretty bad.
Right.
And I do think there's been a fair amount of forced liquidation that no one's talking about, but I think, you know, people who are holding on to, I mean, I've sold a ton of my Tesla. I mean, if I've just can't hold, I mean, I still own a lot of it, but
Yeah.
it's been, you know, I've actually converted a lot of my stock to leaps, just to kind of raise cash and not, you know, play it on margin so much. But it's been, yeah, it's been devastating. I mean, it's been really bad.
So you're talking about like, yeah, so like we've all been pretty nervous, right? And we're getting a little bit more panicky. But and we were talking about this before we started recording. I feel like just the main street America. I don't feel the panic necessarily from them. They're not really paying attention to the stock market just yet, right? A lot of times when you get that panic, then all of a sudden we'll all probably start getting calls from people who aren't really watching the markets and asking us what's going on with the markets,
Yeah,
right? Why is it falling
that's
off?
true. I mean, I remember at the COVID lows, I had
Yes.
tons of people
Yes.
calling me like, "Oh my God, what's happening?" And you're right,
Yep.
maybe because it was so, you know, over 6, 7 weeks, people are losing, you know, half their money or more. It, you know, this is almost like the, you know, boiling the lobster, a lobster in the kettle or the frog in the kettle. Like
Right.
you start it slow and you don't realize you're boiling until it's too late.
Yeah.
It's a different feel. You're right. I haven't had a lot of inquiries like that, but um,
Now it's not a requirement. It doesn't have to
it's
happen,
not a
but that's
requirement.
the
So
that's the one thing that's been in the back of my head that I just haven't seen that out. And like everywhere you turn, like any TV channel you turn on or whatever, they're just talking about the market and everything blowing up everywhere, right?
I don't know. I almost feel like people have given up though, because let's just pretend that you're in the market and you're
Yeah.
holding like an ARC fund, like that I lost a ton of money on when I went in early in the year.
Right.
I never dreamed. I thought they were probably near the lows, right? They're already
Mhm.
down 50%. You
Mhm.
know, I took like 20% losses on them, and they went down another 50%, right? So, I mean, if you're in speculative areas and decided not to sell, if you're not panicking now when you're down 80%, then I
Fair
think
enough. Yeah.
you've probably given up and you're like, well, whatever, it's not all my money and you know what I mean?
I'm
Yeah.
down this
Yeah.
Like
much. What's
there's been enough reasons to panic. I mean, if you're
Yeah.
down that much, I think you're pretty much like, I'm never gonna sell whatever, you
Mhm.
know? So I don't know. I mean, it's been brutal. You know, I was looking at some of my notes and so the investors' intelligence, you know, came out today, right?
Yeah. Yeah.
And bulls were at 25%, bears were at 44.1%, which is a very extreme reading. The spread is a negative 19.1%. That's the largest spread since 2009.
Mm.
So, you know, these are like readings that you get at the bottom of major bear markets. Um, you know, you never know. I mean, if you maybe, Arish, you want to pull up maybe a monthly of the bears, and if you see that, and you can kind of see one reason why I pay attention to these indicators. When you put up the chart, I'll show you what I'm talking about.
Yeah, we have a little transition time here,
Okay.
but I just want to mention that for people that are maybe not watching the video that are listening to this, if you want to see these charts, they are available on the video portion. You can get that at investors.com/podcast and see these charts and the panels that Charles was talking about. But here we go. Now we've got the MarketSmith chart up, and by the way, you can also most of those that Charles was going over. He was going over them on Wanda. You can get most of those by typing in NASDQ on MarketSmith as well. So the put call ratio isn't on that panel, but you can get that elsewhere. And I can also show you some areas on investors.com where you can get those. There's the psychological indicators that you can get under the market trend. But go ahead,
Yeah.
Charles. Let's
You can get the bulls and bears and
the
on
bulls bears, so
investors.com too,
you
right?
can see
Yeah.
those crossovers.
Yep.
It's nice because it's got a red line and a green line. The put call ratio, and yeah. So Charles, why don't you go ahead and talk about this chart here that we're looking at again on Market Smith. This is zero BEAR, zero bear. and this is a monthly chart. So
So
tell us what you're seeing.
this is showing the readings of the bearish advisors on this survey, and there were some very, very extreme readings during the 2008 period, right? And that was, the financial crisis, really a global meltdown. I don't feel like I'm going to even use that as a comparison because I don't think we're in anything like that. I mean, certainly the fundamentals, in my opinion, don't warrant that. I mean, we've pretty much record employment. The economy is still has been strong, even though it's hopefully slowing so that inflation slows. Really the only main thing that's killing us right now is inflation, really, and the whole disruption in the supply chain. But if you look at some of the other readings, so in the September 2011, we hit at 46.3%. We're currently at 44.1%, so we're pretty much there. That marked the market low in September 2011. That was a low in the market. Then the next reading,
global
July,
recession fears were going on at that point. That you had the Greek debt crisis.
Right.
But what was interesting is you didn't actually have your follow-through day that worked until December 20th of that year, in 2011. So, you kind of slopped around a little bit after that low.
Yeah.
So,
but that was the low.
Yeah.
I mean the spike in bearishness coincided with the low in the market, and then it took some time, I guess, to come out of it, but at least you weren't going down further, and there are probably things you could start building your watch list and maybe start, the trend started to be on your side, or at least not against you.
Yeah.
January 2016, we had a spike up to 39.8, so we're higher than that now. That also marked a market low. Didn't go lower from there. The market continued to rally up and, in a bull phase. Then we had the 34.6% spike in December 2018, also coincided with a low in the market, and a bull market after that. And then in February 2020, so that was right around, that was the COVID low, right?
Yes.
Yeah.
So that was 41.7%. So we're higher than that now. And that also marked the low of the market. And then more recently, just back in May, we hit 44.1%. So we're right back at that level.
Wow.
And that was the one instance where you didn't get a market low. You did get the beginning of a tradable rally, though, right? So we're right at these levels where, in the past 5 times, we've either hit a definitive market bottom or at least a tradable rally. And again, this is also coinciding with a low in the stochastics. We haven't been this low in the stochastics since 2008, and before that 2002. We have all these, the AAII survey's been very, very negative, bullish readings in the teens to 20s, and bearish readings in the 50 to 60%. So again, everyone's kind of on one side of the boat and expecting the worst. And so that might set us up for an opportunity, but again, we should wait for the follow-through day because, all these indicators are saying, hey, we're near a low, like, go for it. But the market has not been cooperating, and who knows? I mean, it can get a lot worse in the short term and say, oh, well, I was off by a week, but you can get creamed in that week.
Yeah, I mean, like
So,
if you go back like to like March of 2008, that was getting up to a high of 44.70, just like you were saying, Charles. You had here, you maybe it was like a short-term low, in hindsight, but then it went up to that 64.40, right?
Oh,
so,
yeah, no, that was
really
like
good point.
Insane, yeah. So yeah, again, use these as kind of to inform you of what might be happening, but play it safe and wait for a follow-through day, because the follow-through day is consistently has worked with every major market turn. It's not going to get you in on the bottom day, but it's not designed to. It's designed to get you into the market when the trend is your friend, or at least there's that possibility. And you know, it's a way to get in prudently without risking too much.
Mhm. And
So go
a
ahead.
lot of times, I guess I look at the secondary indicators. The value of them is it kind of gives you the sense that you're in an environment where things have gotten to a point where a follow through day might be more meaningful. Because you get false follow through days, right,
Yeah,
all the time. And sometimes I look at, oh, if you got the secondary indicators telling you, oh, you've really washed things out a bit, then it's a more meaningful follow through day as opposed to something where, oh, you know what, you just kind of came down a little bit, you really didn't wash people out, and it doesn't give you the sense that you can have a real powerful rally afterwards. So I
yeah,
guess sometimes it gives me that extra optimism that, oh, what could follow could be even greater. um, but one thing I just want to mention, because I hadn't noticed this before, but 1994, there was a pretty big spike there. The Bears actually went up to
Yeah.
59.1. And it was interesting because we were kind of talking about that 94 correction. There was a major rate hike cycle there. Seven rate hikes. This is something that David Chung and I talked about on a podcast previously. Um, but it wasn't the 75 basis points each time like we've seen this time around. It kind of ended with that 75 basis points and then another 50. But uh, what do you make of that? That wasn't a very severe downturn in 94. You mentioned that it was just 14% of a
yeah.
correction, but
So
it
I
got
was
that extreme.
actually I actually tweeted about this, and I was wrong, but I was using 94 as a precedent for this time period, just based on the interest rate hike cycle, which again started slow with 3/4 point hikes, and then two 50 basis point hikes, and then ended with a 75 basis point. So the total rate hike was 2.5% back in 94. And again, it happened, 7 increases that year. So this year we've already exceeded that. Now we're up to 3%, aren't we?
Um, yeah, I mean, so you went from 3.25 to 6, because I also included in that cycle, there was a February 1st, 1995, which was 50
Oh,
basis
okay,
points
okay,
right after the
okay,
75. So,
okay.
so yeah, there were 6 in 94, and then there was that one last one to kind of cap it off in February of 95.
Yeah. Um, yeah, no, we I thought we, as we mentioned, off air, conditions were different back then. The 94 bear market was is much less severe, just down 14% on Nasdaq. From high to low was just 3 to 4 months. Um, Interestingly, though, one thing I did when I'm kind of looking for precedents and looking for market precedents, the other part of that isn't just looking at, well, how did the market behave, but what were the stocks that came out of those periods? And two of the stocks that came out of those periods, one was Cisco. So Cisco was a gigantic market leader going into 94. Like from 91 to 94, it was up, I don't know, let's just say 500%. It was up a lot. I'm not
A lot,
sure
yeah.
how
It was it
much.
was in the thousands.
It was up a lot.
Yeah,
And then it had about a 50% correction during 94. And it came back to lead again. So,
very long base.
a long base, rounded out. It it actually hit a low after the market hit a low.
Mm,
Uh, Interestingly, yeah. But I printed that chart out just to kind of inform me of, well, how did it act? And it gave you many opportunities to get in before it actually broke out of a cup with handle. But it took a long time after the follow through day to actually break out of a full on cup with handle. So you're going to have time with some of these. And like, like, you know, I still have a big position in Tesla, which is looking terrible, but maybe that's going to be kind of like a Cisco, you know, down 50% and eventually build a base. And maybe some point next year, it actually completes the base and is, you know, maybe up near the 300 or 400 range, you know, closer to new highs where it gives you a proper setup. But the other stock that broke out in 94 was Ascend, which
Oh,
was one
yeah.
of the greatest model book stocks of all time.
Right.
Mhm.
And so it had IPO'd, and it was bucking the trend. And when the market took off, it really started to take off. So looking at, you know, looking for merchandise like Ascend that this seems to be bucking the trend and doing better, you know, that's where my focus on like Shockwave or Celsius comes in, because these are kind of newer stocks that people haven't heard of. And, you know, I don't know that the market opportunity is the same as like an Ascend. You know, Ascend was in the networking space at a time when,
As was Cisco, you know.
and Cisco, and this
Yeah.
is at the, you know, the kind of the beginning of the internet, like when things are really starting to grow. So they were like really in the right place at the right time. So I don't know that the market opportunity is similar with some of these other stocks we're looking at today, but there's a lot of things happening, you know, in the world, you know, with AI and electric vehicles and biotech that are going to have huge markets. So there's going to be another stock like that that's going to come out of here. So, you know, that's really what I think where you want to screen is for stocks that are showing incredible relative strength in this market weakness, and are the first ones to come out that have really great total addressable markets, and they're leaders in their space.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.